Hey, everybody, we are going to talk about one of my largest investments, GM, General Motors. I can see Tyler already starting to roll his eyes. But before we get into it, I want to take a minute and share a link on my screen right now, fool.com/Frankel. Get a top 10 stocks to buy right now for free from the Motley Fool. It is the best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So I mentioned GM is one of my larger investments, and I don't have a super concentrated portfolio. So when I say larger investments, it's probably like 4% of my portfolio, something like that. So GM is an incredibly cheap stock. I'm going to kind of briefly just lay out some of the good things about it real quick. One, it trades for about 4 times forward earnings. I feel like it has for a long time. And Tyler, the one thing I want to get a thought in your mind before I lay out some of the things I like is that every year I hear, oh, it's 4 times earnings because the auto industry is about to take a nosedive. And I've been hearing that for about the past 5 years in a row. And it hasn't the stock continues to be profitable.
Well, if just to help you out with there, it has traded for less than 7 times forward earnings since 2015, at least as
Right.
far back as like the data I have looking at it right now.
You're absolutely right.
It's always cheap.
But the reason that people keep giving me when I ask them why is it so cheap is, oh, well, auto sales are great right now, but as you know, next year they're going to fall off a cliff and profits are going to be bad. They're going to have to give all kinds of incentives and their margins are going to go away and it's just going to be pretty bad. So it hasn't happened yet. Um, just to kind of lay out some of the things I like about the company. I mean, if you read through their earnings report, there's a lot to like about it. I mean, their sales continue to do really well. Revenue was up 11% year over year. I would argue that they're kind of winning the EV race other than Tesla. It's going to be a while before anyone really outcompetes Tesla. But GM has, they had the highest EV sales in the second half of 2024 of any company but Tesla. They did it with less incentives than any of their competitors. Their share of the EV market in the US is almost 13%. That's doubled over the past year. And they're really scaling up the EV business. They're the only big automaker other than Tesla that I would say is having real success with EVs. The company's very profitable. And we just mentioned about 4 times forward earnings. And they're using that to pay down debt, which I know, even Tyler, if he's bearish on GM, you applaud that move. They've been paying down debt. They've been buying back stock. They've been, if your stock trades for 4 times earnings, you can't really argue that buying back shares is a bad thing. This is a perpetually cheap stock. You're absolutely right. But the business seems to be doing well. And every year they seem to, increase their projections, not decrease them like everyone thinks they're going to. But then the stock continues to trade cheaply. So, Tyler, what am I missing?
Well, there's a couple things, and like you said, number one, historically, this is a cyclical industry that has gone through we'll call it a cyclical high point. 2024 was a bit weaker. They ended the year with $6 billion in net profit, which is more than 33% lower than it was 10 years ago. So it's, if I bought this in 2015, the company's making 30% or 40% less than it did 10 years ago. On a profitability basis, there has been some erosion throughout time. In the 2015, from 2015, 2016, we're looking at 25, 22% returns on equity to today, the 11% range, which 11% is okay for equity, not great, but certainly not the 25% range we were seeing 10 years ago. So we're seeing like an erosion of profitability, both on an absolute terms and on a rate of return. Cash flow has been good, like in the past year or so. So maybe it did take some pretty large asset write-downs this year, about $1 billion, but it seems to be, it did that, I think, in conjunction with maybe some pivots on its EV business and things like that, because it's moderating the pace at which it's doing its EV sales. And that's not like that's a market reaction. The EV sales in general are moderating compared to what we thought they were going to be in like 2021, 2022, where, there was a voracious appetite for EVs and we just couldn't get enough on the shelves. That's not really the case anymore. So, capital spending is up a bit over the time over the past several years, despite profitability still kind of not quite as good as it was. So going into a period of elevated spending with moderated profitability, there are I if we were to hit a one of the things is with the economic with the automotive industry is it's like it is sensitive to economic times, and part of the reasons, like I think a big reason why people are like, oh, it's going to crash, is kind of like a prediction on like we're going to see a slowdown in the economy, perhaps a recession, because it's been a long time, dude. Like, when's the last time we had like outside of like the COVID shock recession? When have we had like a true GDP contraction over multiple quarters? And I guess the theory being like, we've had a really good run. And I think a lot of people would be like, look, it's going to happen eventually. I don't want to be on the wrong side of owning automotive stocks when we hit a recession. So I think that can justify perhaps why it trades for as cheap as it does. Whether that's too cheap, I don't know. That's like, playing the, trying to stick your finger in the air and try to figure out how fast the wind is going. It's the one thing I'll go to with automotives, just historically, if you were to own them over very, very long periods of time, we're talking decades, they're extremely cyclical, they're extremely capital intense, that you can't really like new models every year and like complete revamps of existing models every 3 or 4 years, so you're consistently having to throw lots and lots of capital in this business to make your returns. And it just historically has not trended well for investors. I mean, there are the boom times, and if you can, time your investment just right in terms of valuation, in terms of hitting the low end of a growth cycle, you can do well. But it, over it, even compare, they have done a much better job than Ford. I will give them that. Ford seems like it's been a hot mess for several years now with recalls, costs, and all that other stuff. But you look over very long periods of time, and these businesses just have not done particularly well. I mean, ever since GM came out of bankruptcy, what, in
2011
2011?
maybe. Yeah.
2011? So like 15 years, its total return is 92% compared to, couple hundred for the S&P 500. So it's one of those things where it's like you're betting on nailing valuation and timing of the cycle, which I used to think I could do that with energy, and then I got my teeth kicked in plenty of times to realize I can't, and it's made me uh, go away from cyclical companies.
Well, you make a really good point that a lot of investors in the back of they're probably like, there is a recession coming. It's going to be bad for this industry because, as you just kind of mentioned, the last recession we had, other than the COVID, anomaly, led to the company going bankrupt. So I mean, it really is, that does stick in investors' mind. You mentioned the capex. It's not just that they're pulling back on EV investment and taking write downs for that. There was also the cruise business that they essentially exited this year, that had been draining about $1 billion a year. So I think that's a net positive from a cash flow point of view. Not if you're a growth investor, the robo taxis are the next big thing, blah blah blah. That was never even a part of my real valuation case. Um, and there is a lot to like about this, but another big thing, and the reason the stock sold off after its latest earnings that looked great on the surface, their CFO, and you can't do this, said we're not taking tariffs or any other possibilities into account when making our guidance. Um, you should. um, that's a factor. If it doesn't happen, consider it a bonus. But you have to kind of take that into account. The CFO clarified that guidance does not consider any regulatory changes whatsoever, including tariffs that could affect the business. So an analyst correctly wrote that their guidance leaves no room for error. And that's true on the tariff and regulation side and the recession side as well. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.